The ISA can be one of the most important wealth building tools that we have available in the UK, but the much loved ISA is under fire, with calls for it to change in some pretty fundamental ways, including one suggestion that I think could render it virtually, completely and categorically useless. So I wanted to do a quick rundown of some of the changes to the ISA and how they might affect you using it, and what Labour might have planned for the ISA. Because the truth is, I've worked in finance and investing for the last 15 years, and I often see people making some of the same mistakes. But first, a quick reminder: the ISA, or individual savings account, is a tax wrapper that lets you invest and protect yourself from income and capital gains tax, making it one of the most tax efficient ways to put your money to work and plan for your retirement. We have 4 kinds of ISA. You've got the stocks and shares ISA, the cash ISA, the innovative finance ISA, and the lifetime ISA. And every year you have a £20,000 limit that you can invest, but importantly this allowance is shared across all 4 ISAs. And you also have the junior ISA, which is often treated as the leper of the ISA family, but I rate it as being the second most important ISA of the lot. Only if you have kids, obviously. And one thing I think we should also point out is that the ISA is a tragically underused investment vehicle. There are about 3.9 million stocks and shares ISAs open in the UK, and there are about 7.1 million cash ISAs, or about 13% of UK adults. And the other two? Well, who cares? Changing ISA limits. Now, there were reports that it was being explored to tackle one of the biggest drawbacks of the ISA. The way they're set up at the moment means that your £20,000 limit resets at the end of every tax year. It's very much a case of, if you don't use it, you lose it. But the suggestion has been to make the ISA more like a pension. With pensions you can make retrospective contributions and therefore reuse any unused balances for the last 3 years. This is one of the biggest benefits that a pension has over an ISA, and I think it's generally pretty generous. So being able to go back 3 years to use your unused ISA balances seems like a really good idea and a great start. This is the first one on our list, and this is going to go in the good change category. We're off to a strong start. But this isn't the only change to the limit that we're going to discuss, and it's not all going to be rosy news. More on that in the video. Multiple ISAs. So from April this year, you've been able to open and contribute to multiple ISAs of the same type in the same tax year. So you can have multiple cash ISAs or multiple stocks and shares ISAs. Previously, only one of each type was allowed to be opened per tax year. And I think this is kind of a big deal, because the truth is that adding flexibility to what had been a kind of rigid system seems like it can only be a good thing. And it means you could potentially have your main ISA with your index funds in a Vanguard account, but then which would cover the bulk of your investing, and then maybe have a trading 2-on-2 account that lets you buy shares in individual companies as and when you want to, which is what I do now. We should also just clarify that the same £20,000 limit applies. This hasn't changed since 2017, more on that later. This one also firmly goes in our good change list. British ISA. The rollout of the British ISA has been scrapped by the government, despite Labour insisting it had no plans to ditch the scheme in the run-up to the election. And for everyone's memory, because frankly, if you couldn't be bothered to remember anything about the British ISA, then I don't blame you. But the idea was to give a separate allowance for investing in British companies of £5,000. My view is that it was always a terrible idea, and as I've mentioned in more than a few of my videos, that's largely because so few people have a stocks and shares ISA, and a vanishingly small percentage of those people hit their £20,000 limit every year. So the idea that you need another 5k but just to invest in British companies seemed a bit silly, a bit dumb, a bit daft. I didn't really see the point. And just to give you an idea of how unpopular this was, Hargreaves Lansdown and AJ Bell didn't support having another ISA product either, with the CEO of AJ Bell going as far to say the UK ISA was a political gimmick that was doomed to fail in its objective of boosting investment in UK PLC. Yikes. And if you think about it, these were people who could potentially collect fees on it, so even they were saying it was a bad idea. However, the government is now set to drop the plan, according to the Financial Times, with one official stating, "We are not planning to further complicate the ISA landscape." Just whilst we're here, I think a much better idea would have been to just increase the overall ISA limit, which has been fixed since 2017. And if you'd indexed it with inflation, then the allowance would be a little over 25 grand anyway. ISA caps. Now this could be the thing that really ruins the ISA, making it a much less attractive investing opportunity. And that's if they started to cap the ISA allowance. This is after a report from the Resolution Foundation suggesting that capping the amount that people can save in an ISA could be a huge increase to the government's annual tax revenue. According to their report, capping the total amount that people can save into an ISA to £100,000 could net the government around £1 billion extra per year in taxes. Now, clearly this is a long way from making its way to legislation, and if it were to go ahead, then its overall effect would very much depend on what the rules were when they were set up. Is it a total cap where you literally cannot contribute anything over £100,000? Is it that you can contribute over £100,000 but it's taxed? What's the tax? How much will it be? There's a lot we don't know. But one thing we do know is that this is a terrible idea. This is just such a shit idea. This is another one firmly in the bad news pile. Not just bad news, terrible, catastrophic, earth-shattering, apocalyptic news for the ISA. And unfortunately the bad news for ISAs isn't done there either. Fractional shares. ISAs will begin accepting fractional shares, making it easier for investors to diversify portfolios and even start with smaller amounts of money. Last year, HMRC said that fractional shares didn't qualify for tax-free accounts. They've now backtracked on this, and you'll be able to buy more expensive stocks from as little as £1 rather than needing potentially hundreds of pounds just to buy a single share. And just as an example, let's say you want to get in on the Nvidia action. Their shares peaked at about £1.35 a share, but if you only had £50 to invest to start with, then you'd have to save up more just to buy a single share. Now you can buy a fraction of that share instead. This change may come into force as early as the 30th of September, according to secondary draft legislation. This is another good thing for the ISA. The junior ISA loophole. So as we've mentioned, you get your £20,000 ISA allowance every single year, then completely separately and in addition, you can contribute £9,000 to a junior ISA. It meant that there was a loophole that allowed 16 and 17-year-olds to save up to £29,000 by combining their junior ISAs with their other ISA allowances. Again, this loophole has been closed. What will Labour do? So as we mentioned, Labour have said that they really want to reduce the complexity of the ISA and make it much more accessible for people to use. This is unequivocally a good thing, but I think it misses the point a little bit. The first thing that they need to do is that they need to market the ISA better, and before they even need to do that, they need to boost people's understanding and education when it comes to investing and the value, the literal value that investing has in someone's financial journey. People are not going to take any interest in an ISA if they don't fundamentally understand the value of investing. That just seems very straightforward. So what's my conclusion? What sort of state is the ISA in? And how relevant is it still going to be to your wealth building journey? Well, if we tally up the scores, we do have a clear winner on this one. But the short answer is the ISA is still going to be a really important part of your wealth building journey, and that there have been some really positive changes being made to the ISA. In the letter that Hargreaves Lansdown and AJ Bell wrote, they said that the ISA is a brand that has been stretched too far to the point where it's lost all meaning. And I think this is so true. It's like the MCU. There are too many offshoots, too many spin-offs. Ant-Man. And all you really need is a stocks and shares ISA. Now, the ISA topic is something that we discuss a lot on this channel, and if this has been inspired you, then make sure you watch this video here. This is 14 common ISA mistakes that people make and how to avoid them, or this one here where we discuss which is the best ISA provider to use. Now, if you want to be in a community where we talk all things personal finance and economics, then do feel free to subscribe. It doesn't cost you anything, and you can always unsubscribe later.